We have 4 excellent papers today. First we have welfare analysis polarization. So we'll go in the order of the program. Welfare analysis polarization by Juan and Neumeyer. We have local currency debt markets, global financial conditions, role of foreign investors, Guilherme Suedekum. The effect of solicitation on sovereign ratings, Marion Boisseau-Sierra. And the Fickle and stable global chemical cycle transmission by heterogeneous investors, Haonan. If you have an ear for accents, you would have noticed that I'm actually not Canadian, but I'm German. So beneath the polite facade is going to be a ruthless taskmaster. So we'll hold everybody to exactly 15 minutes, which will give us 5 minutes for discussion. We will. I suggest we take each paper and then have a brief discussion so that everything's fresh in their minds, right? And again, the discussion can be focused. Please do not interrupt the presenters. It'll only be revealed if you're an economist. It's actually inefficient. So, and with that, we should probably start right away. It already starts.
Okay, good morning, everyone. Thank you for giving us the chance to present a paper here with Neumeyer on dollarization and the welfare analysis. So to dive right into it, this is not working. Okay, like this. So a country with chronic high inflation might see dollarization as a way out of it. And what's the benefit of that? Well, the lower inflation forever, unless we're like Zimbabwe. But that's the benefit. Now, what's the cost? Traditionally in the literature, we've got the Fisher cost of loss of senior rights. When you dollarize, the government loses, the senior revenue. And that's already been studied. So we won't focus on that here now, but what we want to stress is that dollarization implies a higher probability of default because of several things, but most importantly, because dollarization implies that the government, the central bank, needs to buy the whole money supply. In order to do so, it has to do a large initial market operation that calls for dollars. For a country with with access to credit markets, it may be able to do so by using its foreign reserves and then issuing debt to finance, what they need to convert the whole money supply to dollars. So for a country with access to credit markets, it could start off, by issuing debt that would set it in a sustainable path that could lead to default in the future. And we'll show that with our model. Likewise, for a country which is already in default, they don't have access to credit markets. So in order to convert the monetary base to dollars, they would only have international reserves, and they would have to devalue for that trade to happen. And typically that occurs that leads to a small amount of initial real money balances that carry welfare costs. So the question we will answer in the paper is, considering these costs and benefits, how high should inflation be in a country for dollarization to be welfare enhanced? And we calibrate the model for Ecuador, which dollarized in the 2000s. Okay. So what's the model? We use the standard sovereign debt default models based in Marion 2008, and we have dollarization to it, basically. So it's a small open endowment economy where the stochastic stream of tradable goods. The country initially has a fixed exchange rate with a crawling rate equal to the inflation rate. We'll see this more clearly with budget constraints. Revenues from inflation are rebated to the households and a lump sum transfer. And then we motivate money demand by money demand utility function. And then this economy can issue debt foreign debt to risk-neutral lenders from abroad, and these contracts, these debt contracts, are non-enforceable. So the economy can default at two costs. One of them is temporary financial autarky, so they're excluded from financial markets, and then they face the probability of re-entry to these markets the following period. And then there's also widening autarky and output loss, which is traditional in this literature. And so what we do is consider the case of a benevolent government that maximizes the lifetime utility of a household. What are the budget constraints in this economy? So for an economy that has not dollarized and maintains its national currency, budget constraint, they consume, they buy international reserves at price Q out, they demand money, they demand foreign debt, price Q. This price Q is endogenous, and we, carry the default probability in it. And they do this with their income, previous assets, previous reserves, and all money balances. And they get this style, which is the transfer from the government, that when the government rebates the senior. So when considering the aggregate budget constraints, the terms in red disappear, okay? But if an economy chooses to dollarize, now the demand for money is a demand for something that the economy does not supply, so it must be going elsewhere. And that's what the budget constraint shows for the dollarized economy, in which they consume, they demand money, they issue debt or buy assets, and they have the same income, the same debt, but now there's no TAO, because there's no central bank that rebates, the seed. So these increases in money demand now become either will come from trade balance surpluses or from debt issues. Okay, and this is in the case that the economy is allowed in the credit markets, but if the economy is in default, then there's no B, there's no foreign debt, you cannot issue debt. And in this case, we see that in autarky, any increase in money demand will need to come from consumption. Okay, we need to decrease consumption. These are the budget constraints, and then we have a model with representative age and will maximize utility. And default is endogenous. So the economy chooses whether to default or not, given its states, which are output, debt, reserves, money. And the price of debt, Q, again, is endogenous and it's capturing this default probabilities. So what are the results of the model? We compute this object, which is quite a big object, but it's the probability that the dollarized economy defaults, given that its counterfactual economy, its counterfactual national currency economy, would have not defaulted, would have repaid the debt, okay? So we compute this object, and for now, let's consider two output levels, a low output level and a high output level. And the picture on your left is the low output level. And what we see is that, okay, I don't know how clearly you can see this, but as you have more debt, okay, the dollarized economy has a higher incentive to default. And we see this with this probability, which is reaching 0.6, 0.8. And this happens when you have low output. And so this is sort of capturing, we'll try to see from where this comes from, but the dollarization seems to have an impact on default incentives, especially when output is low, especially when debt is high, okay? However, if output is high enough, then default will become very costly, and that's the way how we parameterize these models. There's a default cost that increases with output. So if output is very high, default becomes very costly. And then this effect of dollarization increasing default incentives relative to maintaining your national currency sort of starts disappearing, and unless you have pretty high rate of around 100% GDP. Okay. So this shows that there appears to be an effect of dollarization on default incentives. Now, where does this come from? We argue, as I said in the beginning, that dollarization implies an initial market operation that might set the path of debt in an unsustainable way. I simulate data from the model and compute these probabilities that I just showed you and simulated data. And what we found is that initial output does matter, like initial conditions matter, where you come from matters. The picture on the left computes these probabilities I have just showed you in simulated data, considering the first 20 years after dollarization. Okay, only the first 20 years. And what we find is that if initial output, the output when you dollarize, like in the case of Ecuador, if the output in the 2000s was very low, then the probability that the economy defaults, conditional on the non-dollarized economy repaying the debt, reaches up to about 80%. Okay. And again, this is decreasing in output, so that the lower your output, the higher this default. The lower your initial output, the higher your default probability. However, as I said before, this is the first 20 years. If we go into the long run, we drop the initial periods. We consider like 500 years after dollarization, okay? So we forget about these initial conditions, we forget about this initial open market operation the economy had to make to finance the dollarization process. This probability is basically zero. Okay, there's no long run effect of dollarization in changing the floating point. So I don't know. We're doing 5 minutes. 5 minutes, okay, good. So up to now, I've showed you that it appears that dollarization has an impact on default incentives, especially when output is low, especially when debt is high. And it appears that this effect is mainly because of the initial, or it appears to be because of the initial market operation. That sets the debt into an unsustainable path, especially if your output was low and if your initial debt was high. In terms of welfare, what does this imply? So what we do is we compute the inflation rate at which an economy would dollarize, okay, would see dollarization at that inflation rate or more, would see a benefit from dollarizing. Okay, we do these for calibrating the model for Ecuador, okay? And what we find is that this inflation rate is quite high. So let me tell you what these numbers mean. These plots show the break-even level of inflation at which dollarization becomes welfare enhancing. Let's look at the plot on the left. That's with access to credit markets. And it's plotted as a function of initial assets. So the further here we go, the more debt, the more initial debt you have. And the numbers are percentage annual inflation, but permanent. Okay, so these numbers mean that, for instance, an economy that has initial output 10% below its trend would dollarize if inflation was around 150% a year permanently, forever. So it's a very big number if you come to think about it, because it's not just 1 year of 150% inflation, it's 150% inflation forever. And then if you've got output, for instance, 10% above trend, dollarization would be welfare enhancing if permanent inflation was around 100%. So it's still these numbers are pretty big. This is with access to credit markets. With access to credit markets, the economy can issue debt to finance the dollarization process, okay? And we see the numbers. What happens if an economy is in default and you kind of issue debt to finance the dollarization process? Well, the picture becomes a bit worse in the sense that the inflation, if output, on top of that, if output is low, then the inflation rate would need to be around 250% a year permanently, which is, again, pretty high. And this is the case without access to credit markets. This is the case in which the country, the only thing it can do is just switch its foreign reserves with the money supplied by means of a devaluation, okay, to facilitate this trade. So, well, these are our results on welfare. So to conclude, we've built a model to quantitatively assess the welfare effects of dollarization, and we see that it's welfare enhancing for economies that would have a very high level of inflation permanently in the range of 100 to 200% a year permanently. And let me just mention, this has all been done by assuming that if the country dollarizes, it would inherit the inflation rate from the US, which we have set at 2%. So what are we missing with these welfare costs? Well, they are underestimated since we're not including the cost of the more volatile business cycle, other costs of inflation, since this is a very simple model. And we do not have growth in this model. So if we had growth, we need to think that as output would grow, money demand would grow. And money demand is growing for something that is US dollars, which the economy kind of constantly supply. So that would even put further pressure on debt. So that's why these welfare costs on one hand are underestimated. And to finish with, they're overestimated since we only have one reserve asset in the dollarized economy, which is money. And because the dollarized economy can use interest-bearing deposit backed by money on the fund. And well, this is what we've done. So thank you very much.
Great, thanks. Right away with a question. I have if there's any time an awkward moment of silence, I have questions prepared, but if not, I'll just send my comments to the managers who will go ahead. Question.
So, to the question slash comment. Now, when you compute the initial cost that you have to buy out the money supply, I guess in your calibration, you need to assume that some of these countries, they're already partially dollarized. So a big chunk of the money supply, you don't need to buy it because it's already in dollars. So
Yeah.
I guess that would change your calculations.
Yeah.
Why no?
No, that's being considered.
No, people have dollars, but that doesn't mean that with the dollars, you cannot tell people, oh, you have this peso bill, and just have it.
No, I'm just saying that, so think about leveling in which 95% of the money supply is dollar, then you adjust to buy 5% of the money.
Yeah, that would make
I'm just saying that.
You have to buy all your outstanding local currency liabilities.
Yeah, which is a small chunk of your money supply.
Yeah.
A very small, could be a
Yeah,
very
could
small
be.
share of your money supply.
I think what you're trying to say that technically, if in this model, we're not allowing for private households to have dollars that they could use for a transaction from before, so that
The only thing I'm saying,
Yeah.
let's suppose to take it to the limit. Let's suppose a country which is already 100% de facto dollarized.
then it's different.
Then you will,
Yeah, you don't
but
have-
then there might be an intermediate thing. So if you have a country where 95% is de facto dollarized, you're not going to buy 5%.
No, you have to buy all the outstanding peso, local currency
Yeah.
there.
Which would be very,
is,
very
whatever
important.
it is,
Yeah.
it's that number from 0 to something.
Yeah, okay. And my other comment, if I, is that maybe what is very costly is not your permanent high level of inflation. It's that when you don't have a good nominal anchor, you end up having, very volatile inflation. So you could have periods in which inflation, well, you had it in Argentina, right? Period in which inflation is low, and then you have peaks of hyperinflation, and that must be very costly, right? I assume.
Yeah. No, in this case, yeah, inflation is set again. We don't have that effect. So it's just the inflation that we just found. So we don't have volatility effect. Yeah. And yeah, regards to your first question, yeah, that's being considered because when we do these calculations, we consider the whole aggregate, so we don't distinguish between public and private sector. That's also limitation of the model. But then we aggregate. So if the private sector has large stocks of dollars, then that would be in the B zeros and F zeros, and so it's taken care of.
Yeah, so thanks for this. So my question on this seems to be very much built on sort of Latin American sample. I'm just worried, just wonder what kind of parallels or differences you would see in, for instance, like a economy like Kosovo, to uses the euro but probably is more integrated economically and has a closer connection with the business cycle with the euro area than the US. I don't know if you thought about that and thought how you would calibrate the model for such a comparison, or if you could use it for that.
I have not thought about that, but yeah, it's true this is built on more like, Latin American economies.
Yeah.
Now, as for your question, I think it could be applied to also the sort of economies. I'm not an expert in the case of Kosovo, but yeah, I think the country is a very general model. So yeah, but I'm happy to discuss it with that.
So this is just a clarification. Right now in the model, it doesn't matter whether the business cycle is synchronized with the US or not.
It doesn't at all. Yeah, it doesn't even have zero. That's my concern.
Yeah. We have time for one last quick question. Single part, not two part, please. All right. Well, then we ended up just on time. Perfect. Thank you so much. Right. Presentation.
I can use it. Okay, thank you. All right, and thank you everyone for being here today. Third day, 8 a.m. So I really appreciate you guys taking the time to come. Not very easy sometimes, so let me put my time in here. So today I'm going to present a paper on that basically answers like the question whether the presence of foreign investors contributes to the transmission of global financial conditions to local currency sovereign debt markets. This is an empirical paper, so we are moving from a model to empirical, and this is going to be focused on emerging market economies. So just to motivate a little bit, the question is coming from some developments that happened the last 3 decades in international finance, and I don't have to preach to the choir. So, for instance, we all know that in the 1990s, there was a crisis that hit emerging market economies that they kind of highlighted the risks associated with borrowing externally in foreign currency, and to reduce the vulnerabilities. Some of emerging markets, they put in place policies that they could kind of develop the local currency sovereign debt markets, but also to promote the participation of foreign investors in those markets. So although countries successfully, to different levels, they reduce their reliance on foreign currency debt, such efforts, they might have had an intended consequence of also amplifying global financial shocks to the domestic economy. So what I do in this paper is exactly to show that presence actually it does contribute to the transmission, and I will do it more specifically, showing that, for instance, the higher the share of local currency government bonds held by foreign investors, the more sensitive the credit risk associated with those bonds. They become more sensitive to global financial shocks. So this is something that I'm sure like it's not necessarily something unexpected, but the way I'm gonna show it kind of empirically is that this is the case. And another very interesting point that I make it that's for instance, the higher this presence and the higher the share held by these foreign investors, the closer the sensitivity of the credit risk associated to local currency government bonds gets to the sensitivity of the credit risk associated with the foreign currency bonds. To the point that at 45%, when the participation is 45% for investors, that sensitivity is statistically the same. So I will come back to this like with the results and then we can discuss a little bit more. So I would kind of establish these findings in sort of the two approach. So two sort of empirical exercise. First, my main empirical analysis is going to be based on data for 60 emerging market economies. Those are the usual suspects. Those are large emerging markets where have large local currency sovereign bond markets that foreign investors they have access to. And I'm going to assess how shocks from global financial conditions, and here I'm processing by changes in the US dollar index, they're going to affect the sovereign spreads in country year weeks with different kind of levels of foreign participation. So basically, I'm just to be specific here, I'm comparing the responses of credit risk associated with local currency bonds, which I'm using here a variable from Duschröger with those credit risks that are more the traditional measures of credit risk associated with foreign currency debt. And I'm going to use the CDS. Now, to finish my paper, I'm also going to do event study based on exogenous outflows of foreign investors. And I'm going to see how this change, if there's any sort of change in the sensitivity of local currency sovereign bonds to global financial conditions when we have this change in sort of the level of foreign investor participation. And I will come back to this more into detail. So this probably will be the part that I will say for the interest of time. I'm going to skip the literature, the related literature to my contribution. But since we are sort of an interdisciplinary conference and we have a lot of practitioners as well, I just wanted to point out some kind of policy discussions that have been going on in this last decade, which I think is very relevant to sort of to ground like the paper, but also what I think is probably interesting for us to be discussing as well. So this paper is related to this bulk of the large body of literature that is focused on financial fragility of emerging market economies. We started off with the regional scene. There is when I was writing my paper, there was a comment from Zhou that you shouldn't be talking about paper of other people too much. It's already difficult to explain your paper. So we have Hugo here in the room that is a very important contributor to the original scene. So I'm not going to spend too much time on this. But what the literature mentioned is that, for instance, like the inability of developing countries to borrow externally in foreign currency, push them to accumulate currency mismatches in their balance sheets, which will make them very vulnerable to global financial conditions, those shocks. And then in a more kind of recent body of work, kind of really focusing on the experience of a small, I would say without hesitation, a small number of countries, but countries that are very important, that they manage like to move away from borrow externally in foreign currency, but they are able to borrow externally in local currency. So what they say is that, for instance, in this case, we are not necessarily getting rid of the problem. We are just pushing away the currency mismatch that was in the borrow balance sheet to the lender balance sheet. So whenever you have those shocks in the global financial conditions, you face similar problems in terms of the countries, the borrowers, they still are vulnerable. So some of the papers, they already mentioned that, for instance, the increase in credit risk when that happens, or how, for instance, the foreign investors, they divest, they sell off their bonds in local currency. What I do, I tie up together this kind of dynamics, really showing how the level of foreign participation really have an effect on how the sensitivity increases. There's also literature showing like the differences between credit risks in both types of bonds, both local currency and credit and foreign currency. And I just wanted to point out the paper from during Schroeder in 2016, which makes the argument, a hypothesis, a theoretical argument, that the higher the presence of foreign investors, they become more closer to be the medium investor. So they, since they are the major investor in foreign currency, the way they, let's say, they price credit risk, when they become more and more the medium investor in local currency, they're going to price in sort of a similar way. And my empirical findings kind of provide evidence in that regard as well. And lastly, I just wanted to point it out that, for instance, we do have also a literature looking at index rebalancing as a natural experiment. And I think this is what I'm doing in the last part of my paper, but I think this is important to highlight the relevance of benchmark index-driven investment nowadays. And this is something that is become more and more relevant. So, okay, so let me just show some equations, numbers, and graphs. At the end of the day, it's a paper. So this is my baseline model. And what I do, I run the change in the spread on its lag and on the dollar and the interaction between the dollar and the level of foreign participation, and also some controls that are country specific and also the global economy. And this spread is going to be either the local currency credit spread or the CDS spread. And I'm measuring them in terms of standardized change. So it's going to be one standard deviation. And my proxy, as I mentioned, the raw dollar index, the change here is that an increase in this number is an appreciation of the dollar. So if we have what I kind of motivated and what we're showing that in terms of this currency mismatch that the lenders they have now, whenever, for instance, you have an appreciation of the dollar, if they are holding local currency sovereign bonds, those assets they're going to be vis-a-vis the liabilities that I have back in their countries. You have that mismatch. So, for instance, they're going to sell it. When they sell and they leave the country, you have an increase in showing your sensibility. So I hope that this is going to be clear when I show the results and the graphs. Lastly, I just wanted to point out that, for instance, my explanatory variable of interest here is going to be like the delta 2. So basically, the partial derivative of the spread with respect to the dollar is going to model this relationship between global financial conditions and the credit risk. So while the delta 1 is going to show that that relationship at the average level of foreign participation, the delta 2 is going to show how that changes depending on if we're changing at the level of participation. Great. So let me just focus on the first column, which is the most parsimonious result or the model, and where with the delta 1 that I was saying, which is going to be like the let's say the relationship between global financial conditions and the sensitivity of the local currency credit risk, an increase of 1 standard deviation appreciation of the dollar, or appreciation of the dollar, sorry, it will increase the spread by 0.10%, or sorry, 0.10 standard deviation. And this, the higher I have I have foreign participation in the local currency, the higher is going to be that sensitivity. That sensitivity is going to increase. I also run a few other regressions with more fixed effects. First, using country quarter year fixed effects and also week year fixed effect. And these show how this the sensitivity is increasing with the participation of foreign investors. Now, if I move on to the foreign currency spreads with the proxy by the CDS, what you see that is, for instance, ES, whenever you have an appreciation, of 1 standard deviation in the dollar broader index, we have an increase of 0.3 standard deviation of the CDS, which is fairly 3 times greater than what we see in local currency spread at the average level of foreign participation. But we don't have any kind of effect coming on any kind of influence of the presence of local currency, the presence of foreign investors in the local currency market. So this is no surprise because first, foreign currency is only held by, or largely held by foreign investors. But I think the important thing here is to show kind of like a placebo result as well, that if by any chance this was a result of, let's say, immediate variables, probably there will be a chance that something would show up in this results as well. So let me just show graphically what this represents. That, for instance, here we have like in this axis, in the horizontal axis, we have the foreign participation of foreign investment in local currency sovereign debt markets. And the higher we have that participation, the closer the sensitivity of that spread, the local currency sovereign spread, gets to the sensitivity of foreign currency credit risk. I'm already running out of time, so I do a few other exercises. I won't have time to go too much into it, but I just wanted to say that, for instance, I also have this three-way panel approach that which allows me, between other things, just to, oh, I couldn't see like the other line. Okay, anyways, I estimate both at the same time, and basically, which can allow me to see if this difference is statistically significant. For some reason, it's too light that we cannot see it, but it's basically, it's going to show somehow similar results to what I had before, but together. I just wanted to briefly explain the event study and the importance of this, because, for instance, up to now, I had looked at let's say, the foreign participation. And as I said, I also have like this event study that's looking at the exogenous outflows of foreign investors. And what I try to see here is that just, for instance, if before and after, if there's a difference in the sort of like the sensitivity. And I'm looking at the changes in the country weights in the index, in the benchmark index. In March 2014, there was an announcement that the Colombian country weights will increase. And the way the criteria is set is whenever you have an increase of one bond of one country, you have like a decrease of some of the countries. And we can come back to this if you guys are interested to talk. So just to show that, for instance, like the results in this case is just to say that whenever you have in these countries that were affected, is that they had an outflow. So the sensitivity will decrease, and the country that didn't have, they would not decrease. And I think the music means that it's time. It looks like the Oscars. So I will just jump to the conclusion, which is just bring it up together like the results, showing that the foreign participation makes those markets more sensitive to global financial conditions. Yeah.
Great presentation. Just one very quick question. So here's the student sugar local currency credit spread, right? So I'm just very interested in whether this adjustment, whether the adjustment is on the interest rate differential part or on the forward premium part, right? So if the adjustment is just because forward premiums are more sensitive, but from the standpoint of emerging market issuers, they don't really care because they care about the actual interest rate differential. They don't care about the F minus S. Right? So I just want to have a sense whether which part is actually moving.
Yeah. So great questions. I didn't open up like the controls, but in the controls I'm kind of like I'm also controlling for a currency risk, a forward currency risk. So based on currency swap rates. So I think like in this particular case, there is another paper from Zhou 2023 that they kind of like try like to do both things, like to look at the effect on local currency credit spreads, but also on the currency risk to see if there's any kind of difference. They find it sort of like an impact on the currency risk, let me put it that way. But for instance, the fact that I'm controlling here, I think that's still like I'm trying like to argue that still some impact in the local currency rate. Yes.
Yeah, thanks for an interesting thing. I was wondering if you controlled for the size of the local financial sector. I was thinking in cases like South Africa, when they ran sell-off, that's when they repatriate their foreign funds. And also, you know, it has a spike in interest rates, they have this offsetting factor, but then for less developed financial markets, you don't have the same size of financial sector, or maybe, I don't know, I mean, I think it's also a sector of financial development, maybe they're less. There is a sizable financial sector, but they don't have that many foreign holdings, or there's still capital controls.
So in this particular case, most of, like all these countries, they have like sizable, you know, local currency sovereign debt markets. It is true that for instance that varies, but all of them are very sizable. What I do control, I have robustness that they look at, for instance, the difference if there is any particular influence of capital controls, financial liberalization, and actually the results hold, even like when doing robustness checks in that case. And in this last event, in this event study, my second model, I try like to see, for instance, like controlling for the size of the of those markets to see, like for instance, as a share of the market, like the percentage of outflows, and the results are still hold that, for instance, like whenever you have like those outflows, the sensitivity, once you have the outflow, so there is a
that's a net or a gross outflow?
There is a net, because I'm working with this natural experiment that, for instance, it's just an outflow. Okay. So it's a net outflow. So the results are still hold from that, At least I try to. Yes.
Have you considered local holdings of foreign debt? I think like a country like Chile or Colombia with big pension funds. When there are changes in global financial conditions, that causes their allocations to be out of balance. And then forces them to make trades in the local market. And if there's a correlation between that kind of local investment outside investment or locally, like the countries that have a lot of foreign participation, all of those countries open arrangements, and they have a lot of investments going on as well.
Let me see if I'm getting the question. So in terms of like how local investors are behaving, in terms of if you have this shock, if they bring money back, So I didn't have anything like kind of addressing exactly like these issues. What I can say is that, for instance, because it's not necessarily like the scope of the study, but what I do in terms of like conclusions and sort of like putting, or at least suggesting that a way forward with the research agenda, is that it is true that, for instance, like local investors, they might have like a different sort of incentives, and they behave in a different sort of ways that we don't necessarily comprehend very well so far. And this is something that I wanted to explore in the future.
Thanks, we've run out of time.
Can I just have a quick manual question? I'll save it for after. It's fine.
All right, thanks so much.
Yeah, so thank you for attending indeed this session. And I'm very glad to present in this session and contribute to the interdisciplinary of this canon and also of this conference, because I'm not an economist, I'm a researcher in accounting, and I focus on public sector debt accounting more specifically. So I'm an assistant professor at Cambridge Business School, and this paper entitled The Effects of Solicitation on Sovereign Rating is co-authored with Reining Petacchi, who is associate professor in accounting as well at Georgetown. So we have, we all know that credit rating agencies are a key player in the sovereign markets, both in the foreign currency market and also in the local currency markets. And they, help the asymmetry of information, and also, but they are very criticized as well. We have seen it yesterday at the Banque de France in the discussion, for example, where the governor from the Central Bank of Ghana mentioned credit rating agency and the downgrades before the default of Ghana. So Governor Ernest Addison yesterday, and in this paper from The Economist, emerging economies also say that rating agencies are sometimes biased against them. So one fact that often comes back is the issuer pay model. So who pays for the rating? Yeah, it's the issuer themselves. And also one second aspect is the solicitation. So whether or not a country decides to pay for its rating and therefore get a solicited rating, or the rating agency decides on itself to rate the sovereign and therefore issues an unsolicited rating. And the regulator, the European regulator of credit rating agencies based in Paris, ESMA, is also looking at this issue and says that unsolicited ratings should never be used, so the ones we do not pay, in order to suggest that issuers could pay to obtain a higher rating. So there is kind of this debate on can you pay to obtain a higher rating or not? What we try to see in this question is study first the determinants of the solicitation status. So it's still an empirical paper. So the color gray didn't seem to show clear, but that's a determinants box. And then the effect of the solicitation on rating, and the accounting part is the assessment of sovereign debt. Does it flow via the assessment of sovereign debt? So our sample is large. It's 135 countries. It's every quarter, and it's over 25 years. And we study mostly the local currency domestic issuers, so hence the paper being in this session, and the traditional controls would be there as well. So first we're gonna see on the first box. So what do we see in terms of who solicits and who does not solicit? We see that it's the big actors who or do not pay. So it's the larger your economy are, the more likely to are to have an unsolicited rating. You're not going to pay if you are France or the US, very likely. And on the opposite, we see that if you have you experience high public debt growth, if you have high corruption level, or if you're very close to the threshold of being investment grade, then this is where this is the type of country that would pay for the rating and solicits. So it's very important to control for these cross-country differences when we look at the effect of solicitation on ratings. So we're gonna look at now this effect and how the solicitation at quarter T and then the rating at the next quarter. And first, and add a few fixed effects along the way. So first, there is no fixed effects, just the controls. And what do we see? We see that in the cross section, countries with higher ratings or those who have an unsolicited ratings. So it is typically, as an example, the case of France, would not solicit. Oh yeah, everything that is gray disappeared. So it's AA2, that's the box of the rating, and then Moldova, B3 would be would have a low rating. So France is not paying, Moldova is paying, and we gradually include those fixed effects. So country quarter year, I saw them in the previous paper, and quarter year, and then country quarter fixed effect. We will gradually use them as well. So in the second tab here, we are holding country constants, and then there we see that on average, unsolicited ratings are lower than solicited ratings. So here there is an important switch in sign. Previously, no controls, it was a positive, and now it becomes negative. So really, whenever that's an example. If you have Mozambique. Oh, everything in gray. Okay, if you have Mozambique and you're rated by S&P, then this is a solicited rating, they pay and they get B2, B1, B minus in fourth quarter of 2006. And for Moody's, same quarter, same country, they get CAA3, so it's a 3-notch difference. So it's just an example, but it's the case also, you know, for Italy, for it's just an illustrative example, and it comes in the average. At the country level, cross country, you pay, you do not pay, you have a lower rating. And afterwards, what we like in the sample is that we have a few solicitation switches. So we have the same country, same CRA, and then they decide to pay or not to pay. And then we're going to use these to see, you know, what's the effect on the rating. So most of the changes are, in fact, from countries stopping to pay. This is what we see in the sample. It's mostly 47 cases where a country just stopped paying, and the credit rating agency does not withdraw its ratings, it keeps it, so it has information enough in order to rate, but it just is unsolicited, issues unsolicited ratings. So, and what we see here is a negative effect. So we see that when a country stops paying for its rating, then it is followed by a rating downgrade very often. So, so this, you know, a few cases, again, lots of gray boxes, but basically we have the case of Argentina, November 2012, and, you know, it went, stopped paying and was downgraded. Mozambique in 2016, stopped paying and was downgraded, or I picked one example by each CRA, but, you know, we have many more, but we have this average effect of we stop paying, we see a downgrade. So, and then we ask ourselves, okay, what could be the channel? We have, we evaluate several channels, and the one that, you know, we, has showed up in the data is this debt channel. So the difference in CRA's forecast or estimate of debt seems to be driving this effect in terms of solicitation. So yeah, lots of gray, but basically this is also the case of Mozambique, and they disagreed. So S&P and Moody's, S&P, you know, had a solicited ratings, Moody's didn't. And when for the solicited rating, it had 108 debt to GDP ratio, but then for the unsolicited one, it was like 131 that year, that quarter. So it can be, you know, 31%. We also, we all know, you know, the tuna bonds from Mozambique, but it's also the case in Ukraine and, you know, in Argentina. So there are many, many other countries. I just picked Mozambique because I guess at the accounting on sovereign debt is kind of a specific country on its own. But here, does this surprise us? Debt as a channel, you know, so we do know, you know, that public debt, you know, has a very interesting accounting made. The OECD says, you know, you can hardly compare public debt data across countries, and the IMF stays the same. So what you put in the model as economists is extremely important. And this is kind of where us accountants come in and say, you know, this is hard work, and there needs to be some more work on it in my perspective. But yeah, the rating agencies have to deal with that maze. They cannot just take the word, you know, for granted what countries tell them. They say me sometimes, you know, we just can't believe. We know it's biased opinion on what their true level of debt is. So we have to do our own adjustments. But they all say it's a very complex area. Fitch is different. Fitch said, you know, it's difficult to prevent discrepancies. You know, it's nothing like an audited corporate entity. So we're dealing with a lot of estimates, and that's just a map of how much countries CRAs disagree on countries' debt level. So you know, in European Union, it would be very harmonized because of, you know, Maastricht criteria and so on. We have a set of norms, but internationally, you know, credit rating agencies disagree a lot on what the debt level is for countries. So and we, you know, so lots of issues, lots of valuation problem and consolidation, perimeters and so on. But so what do we how do we try to explain these hypotheses in terms of solicitation and ratings? Well, there are two hypotheses in the literature that often pop up. It's this first one is the strategic conservatism hypothesis. It's basically you have less information, so it's an information channel. So therefore you're more cautious, and therefore your ratings might be lower. So this has been, kind of more argued in the corporate literature, never in the sovereign one. And then you have the punishment hypothesis, which is, well, CRAs, they will punish countries corporates who do not, pay and or discontinue of paying. So we do several tests to try to see, what's the most probable hypothesis. And for the moment, we use, for example, foreign ratings to distinguish. So the effect that we really saw, table column by column for local currency does not exist for foreign currency. There is just this first column where, yes, if you are an unsolicited, if you are an unsolicited rating, you're most likely to have a higher rating, like the case of France or the US having most likely unsolicited rating. But for the rest of the results we have here, nothing shows up as statistically significant. So therefore, we argue that this seems to be inconsistent with the strategic conservatism hypothesis. So we are more like, this second hypothesis of the punishment hypothesis, we're more exploring at the moment, and it's kind of a working paper, working project still, but that's what we are currently exploring more. So we did a bunch of cross-sectional analysis as well, but I would just give more time for the questions and discussion. But in a very condensed way, what we saw was first the determinants. So large countries tend to not pay. We see that countries close to the investment grade, they tend to pay when they have higher debt growth as well. They tend then to pay. And we do see that when we keep the country constant, the unsolicited rating seems to be lower than the solicited ones. And when there are those switches, then the solicited the rating is often downgraded. So this is in a nutshell the paper, and look forward to the discussion. Thank you.
Thank you so much. So we have a bit more time for discussion. In the back, away.
I know you thought about this issue, but the decision of whether or not to solicit to pay for the rating is endogenous, and it differs for some countries, like the ones that are very good, they will not bother to pay, some will, the other ones don't. So treating the sample is very difficult. You are trying to do it, but maybe you have to model it correct for biases in sample selection, like with the Heckman thing, which really calls for modeling the decision for solicitation to guide the econometric strategy.
Yeah, so I'm very lucky because this modeling has been done.
Yeah.
So by Fulgari et al, it's in a review of finance paper. So the modeling part of the solicitation has been part of one, but it's true that there will always be endogeneity issues, and that's why we try to really use those switches because then it's a bit more keen in terms of we're just comparing within for the same CRA, the same country, just paying or paying. So there isn't this rating shopping hypothesis that is related to the endogeneity.
Yeah, thanks. Seems very interesting. I look forward to reading the paper. So yeah, I think like the correlation is quite what you'd expect. I think the causality is the problem direction. But I think what you mentioned about the changes in the forecasts between unsolicited solicited, was that, I don't know if it was local debt, total government debt, or if it was external debt.
Yeah, it was total, yeah.
Yeah, but I think the way to look at it was if you focus on the external, that you assume that having a credit rating would increase the access to external financing. And then you could actually look there, maybe there is a bias from in the forecast from the rating agencies. I think, obviously there's sources, external sources of borrowing like commodity trade, etc. I don't really care too much about it as a credit rating, but I think if you have a large enough sample, I think maybe you could actually show that there's some bias there on the sovereign rating side too. I don't know if that's exactly where you want to go or what you want to look at, but it could be interesting. But I think it's quite clear. I mean, some are quite natural. I don't know if there's any example where there's been an upgrade and then it's gone from solicited to unsolicited. I mean, that would be very much the price. Often it is a reaction to an expected downgrade. So I don't think the switch from solicited to unsolicited would actually change things. I think he would probably do that because they know a downgrade is coming and they're not happy with that, so they can pull the rating because of that.
Thank you for the comment, especially on the debt part. So I've been very quick on the most important part, but it is what we see that the forecast on debt changes. So there is this positive sign of increase. So basically, they do adjust for, this is where the forecast is increasing. So whenever whenever they stop paying, then the forecast of it is more increasing.
Yeah, I mean, you'd assume that having a credit rating would be beneficial for at least the external financing. I mean, local debt is maybe less of a correlation, but it's kind of weird to see that. So I think it's maybe worth looking at.
All right, thank you. Yes.
Thank you very much. So my question is, what empirically in your estimate, what's the actual contribution of public debt ratios to the rating? Because we know that empirically, GDP per capita and institutions are key drivers of the rating, then external vulnerability also important. So the actual contribution can really drive the change in the rating.
Yes, no, definitely, yes. So it is on the measurement of that issue and what really varies. It is issues on mostly on consultation. For example, intragovernmental debt. Would they be in or out? So this is rating agencies would decide or not, or also state-owned enterprises, like all the guarantees that the governments might have. So this is what plays into how do the CRAs decide or not to consider this as public debt. So they do not only take the YO debt figures. If I understood correctly.
No, my question is, if you consider a typical model of determinants of sovereign rating.
Okay,
you will find
sorry.
the contribution of that is actually not that high.
It's not that high. Okay, yeah. So you would have so then your point is it could flow via the debt, but also via other things.
Yeah, would it really drive the change in rating, even if the estimates differ? I think the contribution to actual rating probably would not be significant to drive change. That's my question.
Yeah. Well, what we see is that it impacts this solicitation aspect is mostly driven on local currency ratings. It does not. So it's true that if it had a true effect, if that was the thing, the only thing credit ratings agencies matter where it mattered, then it would matter also for foreign currency ratings, and this is where we don't see it. So it seems to matter, but we will definitely now more explore this debt issue. What is really driving this effect, and why is it affecting only local currency?
I could add to that, take the chair's privilege here just to. The difference is, of course, that in local currency it does matter because you state in the paper it was sort of nonchalant that it's easy to deal with local currency problems because you can just issue more currency, but with local debt problems because you can issue more currency, but that's precisely the problem, right? I mean, you can just create inflation, and that's why if you have a history of that, then your local currency rating will be worse than your foreign currency rating. That is exactly the explanation of the difference, right? So it's not a puzzle that the local currency ratings are worse often than they are. It's the puzzle is in a way they're exactly the same as the foreign currency rating.
Yes, no, definitely, no, we do, yes, no, this difference in, local currency being lower than foreign is not something, it's not something we question, it's something we could totally accept. It's this effect of solicitation on local versus not, versus the foreign currencies that we are interested in.
So I guess that's
If a EM sovereign sort of stops paying, essentially, the rating is withdrawn. There are the developed markets where they're unsolicited, but they, the rating agencies will cover them nonetheless because they're critical for the larger universe of sovereigns. So how do you account for the fact that, in the case of Mozambique, for instance, when they stop paying, the rating is withdrawn, so you can't really control for that effect. And then the other more practical question is, the sovereignty analytics team is very much sort of separated from the business development side. And so, I used to head up sovereigns for Fitch, Latin America. You wouldn't really know what the terms of the business arrangement with the government were. They were very sort of strict in controlling for knowing how much they pay, and well, you would gather whether they're solicited or not, but that is highly controlled. So how do you incorporate that into your analysis?
Yeah, no, so it's so for the case of withdrawals, like we do see some withdrawals, but it's quite a small sample compared to the one that keep on being unsolicited. So in our data, we do see some withdrawals. This was the case of Mozambique, but it's not it's definitely a marginal of ratings from our data. And indeed, the Chinese walls, between the analysts and more the commercial teams. Do exist, and that's more. We see this effect, and we cannot say much more about that.
All right, thank you so much. Move on to a final presentation.
Okay, all right. Thanks a lot for coming. Thanks to the organizers for putting this paper on the program. So I'm going slightly back to kind of the stage set by the second paper to talk a little bit about this point of contact between emerging market financing and global financial conditions. Instead of looking at foreign investors versus local investors, here I'm looking a little bit more specifically about different types of foreign investors. So I'm just going to tell the story using charts. So this is just a motivation. I think Guilherme already motivates the entire thing super well, so I don't have to say a lot about this. But this is just to give you a sense of the co-movement between, for now it's just the dollar EMBI spread of emerging market versus a particular measure plotted in blue here, which is the implied stock market volatility of the US stock market. So you can see there's a substantial co-movement in a time series dimension, suggesting that the global financial conditions could have a strong effect or implication on how emerging market borrowing cost turns out to be. So this is kind of the broad motivation for this paper. But if you look at country-specific sensitivities, so let's say if you do a regression, very simple regression on monthly changes of EMBI spread onto these monthly changes in the VIX index, you see that from the left-hand side chart, different countries are super different in terms of their sensitivities. So you have China that is barely moving, and you have Argentina that's moving quite largely. And you may think this is sort of driven by country fundamentals, but here in the paper, I'm also giving this explanation that potentially who holds the sovereign bond of a particular country actually matters, which type of foreign investment matters. So here as a starter, I'm just plotting a very simple correlation between the y-axis, which is the betas that you see on the left-hand side, and basically the x-axis is a measure of the investor composition, the foreign investor composition of a of a particular country. So here I'm comparing the shares that are accounted for by foreign investment funds. Think of investment funds in the emerging market space that basically being open-ended mutual funds and ETFs and a small sum of hedge funds. But you can see there's this pretty strong positive relationship. I'm not even showing Argentina and Ukraine here, which is basically towards the right-hand side of the axis, but the betas are going to the roof starting from 2013. So here, the stronger is this presence of foreign investment funds out of total foreign holdings of a country's cross-border portfolio liabilities, the higher is this beta measure. So it potentially suggests also that foreign investors' identity also plays a role here. Of course, this is correlation, right? So you may think that different investors sort into different countries, right? If I'm in investment funds, I might have a larger risk-bearing capacity, so I go to countries like Argentina or Ukraine. But if I'm a relatively stable long-term investor, like an insurance companies or pension funds, I might just want to invest in China or India. So this is kind of the hypothesis I'm trying to disentangle a little bit using security by security level data from Morningstar and from administrative sources like Germany's Bundesbank. So just to give you a sense of the results using charts here, so the overall headline results on the left-hand side is basically the relative to the baseline. If I increase the share of a bond being held by a foreign investment fund by 10 percentage point, I'm essentially going to get 29% higher sensitivities of bond yield to an increase in VIX index relative to the baseline. So it's in relative terms. Right? So if I get 10 percentage point more banks and insurance companies and pension funds, the so-called stable or long-term investors holding these liabilities, I'm going to get a relatively smaller sensitivity. And if you notice these orange bars, they're basically comparing in a relatively narrow set of bonds. They're comparing bonds issued by the same issuer at the same point in time. So I'm talking about secondary market spreads at the same point in time, same issuers, different bonds with potentially different investor composition. So what you can see here is that even if I take into account this kind of differences by taking very high dimensional issuer time fixed effect, you can still see that this kind of gaps remains. Although the gap is a little bit less pronounced when it comes to banks and insurance companies and pension funds, exactly because these investors, they sort into different countries based on country fundamentals. They don't go to Argentina, they go to China, Malaysia, and they go to India. So this is essentially the left-hand side chart. So this is about prices. So the right-hand side charts give you a sense of the quantities. So if I zoom into specific episodes of global financial tightening events, such as the taper tantrum in blue, the COVID-19 crisis in pink, and the global market setup in 2015 in yellow, what you can see here is that the face value of holdings of investors in my sample have this dichotomy. So if you look at investment funds plotted in the dashed line, you'll see that after the onset of this event, they basically sell their holdings. And part of the reason this drives the selling is basically because of the sensitivity of the mutual fund flows and ETF flows. Investors flow in and out of these funds to the global financial conditions. So when there's an outflow, they're basically forced to sell some of their assets for redemption purposes. But in banks and insurance companies and pension funds, they tend to be a little bit more stable. They step into the market to buy when the prices flow to basically sort of stabilize the market a little bit. Here it's just partially because of the sample coverage, but essentially what matters for the prices in equilibrium is going to be how willing are these banks, ICPs, are able to basically step in the demand elasticity or the capacity of these investors to step into the market to stabilize asset prices. So it might be a good segue for me to talk a little bit about the demand facing these emerging markets associated with different foreign investors. So the left-hand side chart gives you a sense from Germany administrative data, the distribution, the composition of German investors in this emerging market sovereign space. So what you can see here is that after 2010, there's a sizable increase in the holdings of investment funds. But there's also a sizable holdings of insurance companies and pension funds, these kind of long-term stable buy and hold investor in this kind of space. But there's a very important difference, which comes back to this title of this session, which is local currency financing. So if you look at it like a snapshot of the characteristics of the holdings of these different long-term investors, focusing on these middle bar, which plots the currency breakdown. You see that compared to investment funds, which hold a multitude of different currency denominations. Insurance companies and pension funds in Germany basically exclusively hold euro-denominated bonds. So the idea is that they have very strong home currency bias, even after controlling for things like observed and unobserved issuer level fundamentals. So the idea is that these investors are sort of constrained in terms of holding currency risk, as well as credit risk, if you look at the top panel. So the idea is that these long-term investors are really facing a very different nature of constraints, and as a result, have exhibit a different nature of demand for these countries, right? So one thing I want to also mention here is that this is not only true for Germany. If you look at administrative data for France, for instance, this is also true. Insurance companies and pension funds basically hold 100% of their emerging market sovereign portfolio denominated in euros. So, and the other thing I want to mention here in this slide is I talked about demand elasticity, which means which basically suggests how willing are these long-term investors to step into the market when prices flow, potentially driven by investment funds buy or sell. So in the paper, I try to identify causally the demand elasticity component of these banks, insurance companies, and pension funds demand. And I show that the elasticity is to the order of 3. So how large is 3? So basically 1 percentage point increase in yield is going to trigger a 30% expansion of the demand coming from these long-term investors. That is relative to what we usually assume in sovereign debt models, for instance. This is a much lower number. So this suggests that indeed the risk-taking capacity or this these exposures, the ability for these long-term investors to adjust their portfolio holdings to stabilize asset prices is going to be severely limited, potentially by these risk-based regulations like Basel III or Solvency II. So the idea for these asset prices co-movement with global financial condition is that although these long-term investors could have the capacity to stabilize asset prices, they don't stabilize enough because they are sort of like a constrained investors. So the final part of my paper tries to use an equilibrium model of emerging market sovereign debt market featuring heterogeneous investors, investment funds subject to outflows, and long-term investors that are more stable in their demand, but with relatively limited demand elasticity, to try to gauge counterfactually, what if we sort of loosen some of the constraints associated with these long-term investors? What is going to happen to the sensitivity of bond yield? What is going to happen to the overall level and volatility? So if you look at the left-hand side charts here, and the baseline calibration here is basically the blue dots. So the size of the dot is going to correspond to sensitivity of bond yield to an increase or an outflow from investment funds. And you can see if you think of these left-hand side countries, the left-hand side dots as countries with relatively low default intensity like China, and if you think of these right-hand side dots as some countries like Argentina, you see very similar patterns as I showed you earlier using the scatter plot. The country with relatively high default risk is going to potentially have a relatively higher sensitivity. And the economic mechanism here is essentially that these long-term investors like banks, insurance companies, and pension funds are relatively more price inelastic with respect to Argentinian bonds compared to Chinese bonds that is basically associated with the tightness of their credit constraints. But if you sort of loosen some of the credit constraints associated with these long-term investors, you get a schedule. You get a schedule that looks like the orange dots here. So the size of the dots here, if you look at, for instance, focusing on Argentina, for instance, is substantially smaller. It's smaller by around 15% in relative terms. So making these long-term investors a little bit more price elastic is going to help a lot in terms of reducing the sensitivity of bond yield to an investment fund outflow to a global financial tightening. And that is also going to show up here overall in the level and volatility of the spread. The spread on average is going to decrease by around 7 to 8% in relative terms, and volatility is going to decline by around 16%. That is basically because overall, the demand of the foreign investors are going to be more responsive to changes in prices so that they can actually step into the market effectively when there is a global financial tightening. So I don't know how much time do I have left, but I just want to.
Plenty of time left.
Yes, great. So yeah, plenty of time to talk about the discussion. So this is potentially a good site for eliciting some of the discussions. So I just want to sort of go back to the broad picture to think about what is the implication of this paper for local currency financing. So we know from Guilherme's paper, for instance, and we probably all know for this audience that emerging markets are sort of gradually graduating from the so-called original sin. So they have been opening up their doors to foreign investors for their local currency market. But my data seems to suggest that these opening up are less likely to involve the true stable investors like insurance companies, pension funds coming from advanced economies. So essentially what happens is that these increase in the foreign investors increase in the share of foreign investors and an increase in the sensitivity of local currency credit spread to global factors are potentially is associated by the fact that the mutual funds, the ETF, these relatively unstable investors are heading into these local currency market. So what potentially may be helping in this kind of aspect is for thinking about, for instance, I'm thinking about higher flexibility in regulating global financial intermediaries. The Solvency II insurance regulation is taking a small step in the sense that it allows like a zero risk rate in calculating some of insurance companies' exposure to European Union countries' sovereign bonds denominated in their own currency. But potentially there's more to do in terms of global coordination. But from a standpoint of these emerging markets themselves, potentially improving country fundamentals, developing a deeper currency hedging market to get rid of some of the currency risk for these foreign investors might also help. But at this point, I have another paper with Eugenio Cerruti at the IMF showing that segmentation frictions and large CIP deviations, high hedging costs remains a barrier here. Of course, we have seen also countries like Indonesia doing some targeted issuance. For instance, they target Japanese market who are relatively populated by relatively stable investors. So essentially, there's potentially a lot that can be done to basically encourage long-term investors into these emerging market, local currency market. And I welcome additional thoughts and comments on this paper and of course on the overall theme of this session. Thank you so much.
A lot of questions. Now, very interesting paper. So what I'm thinking about is, I mean, yeah, these longer term investors you talk about tend to be the one that use a lot of hedging when available, but a lot of, especially for the more immature market, the hedging can be quite expensive. So my question has, I mean, my impression is these more opportunistic investors. I was thinking more of the sort of actively driven tend to quite often focus on the entry point on the FX rates and try to play that, even though that is very difficult. I don't know if you've actually looked at that. And what I'm quite interested in is a kind of reaction when the government maybe has sort of extinguished or used up all its external debt, borrowing options, syndicated loans, and but could potentially just allow for a currency weakening to pull in these kind of more opportunistic into the local currency debt markets. Because often, have quite high rates there. And if you, as a sort of more opportunistic investor, you can come in at a good currency point, get the high rates, and then maybe also, people talk about real yields and stuff like inflation rate, but really as a foreign investor, the only thing you care about is, the FX difference there. And if you can time that well, you can make a lot of money both on the FX side and on the actual high yields. But is this something you look at?
Yeah, so thanks for the question, not exactly in this paper, but I'm doing some analysis on the mutual fund, especially US mutual fund position in currency hedging contracts in the emerging market. And what I find essentially is that there is a lot of sort of, we can call it speculative content in the sense that they really just want to basically, by investing in these local currency bonds, they're not really only investing in the bond per se, they're also investing in currency in the sense that they use currency derivatives to augment their currency exposure. If they have a view on how the currency is going to go, they're going to add on to their currency exposure using derivatives. But the fact that there is some segmentation frictions and the overall low depth of these emerging market currency market is potentially going to make hedging costs on the other side of the market even more expensive. If there is some global financial tightening happens, these speculators, like carry traders, kind of exit the market. That is potentially going to have an additional cost on those real investors that really want to hedge their investment. So this is where I see a lot can be done on this currency hedging front. But overall, a long and short, a lot has to do with reducing some segmentation and friction in the currency hedging market. Yes, very.
About the methodology, how do you estimate the demand elasticity and the tree?
Right. So essentially, the demand elasticity estimation here is basically typically what you can do naively is to regress quantities on prices. Right? But regressing on prices is going to have this endogeneity problem, right? So what I did here is because I only look at long-term investors' demand. So what I do is to extract a surprise residual supply curve shift coming from mutual fund flows. So let's say if I can extract a surprise component coming from large investment fund outflows, from the perspective of these long-term investors, they see this as sort of exogenous shift in the supply curve that they effectively face. So what I do is to use for instance, one version of my instrumental variable is to construct this granularity instrumental variable using the component to extract, for instance, PIMCO, losing bill growth, they suffer from an outflow, and these outflows are surprises from the standpoint of these long-term investors. I use these components to gauge these demand elasticity.
Yes, thank you.
Final question. Yeah, no, just first of all, very interesting. I think like the point about the currency risk. Now I see like your question coming from. Happy to discuss later more on this. But to focus on your paper, one thing that I found particularly interesting is like this sort of different types of foreign investors. And I would just wonder, for instance, like if you have any sort of comments in terms of benchmark index investing, like passive. Because I guess it plays into like the strategy of this different sort of types of foreign investors.
Oh yeah, definitely. I think this is a great question. If you look at these pink bars, I don't have a very specific estimate, but I would say a majority of these pink bars are attached to some sort of benchmarks. Indeed, if you look at Morningstar, for instance, 80% of the emerging market focused mutual fund have prospectus that explicitly saying that they're following some sort of benchmark. They might deviate from the benchmark a little bit, but they're sort of dictated. Their portfolio decisions are dictated by benchmarks. For these insurance companies and pension funds, things are relatively less clear in the sense that they're sort of a part of the strategy, and also banks, they're buying holdings. So even if there are some benchmark rates that are moving, when they participate in primary debt auctions, or if they participate in secondary market, they just buy the security and hold until maturity. So they don't potentially adjust their portfolio that often. And to the extent that during global financial tightening episodes, they step into the market, they become a little bit of a contrarian. Their portfolio decisions potentially a little bit different from a usual benchmark investor would have done in the case of just following the portfolio.
Great. Thank you so much. Thank you.